My name is John, and I want to tell you about two people who are basically the same person. Same age, same job, same salary, same city. They're twins. They both decide to buy a modest home. Nothing fancy. Same price, same down payment, same 30-year mortgage. But there's one tiny difference. One of them pays hundreds of dollars more every single month. Not because he bought a bigger house, not because he made more money, but because his credit score was about 50 points lower. Over 30 years, that small, invisible number will cost him tens of thousands of dollars. How can a number you never see quietly tax your entire life? I'm not a millionaire, I'm not a finance guru, I'm just a regular working person who spent a lot of time staring at bank apps, credit card statements, and interest rates, wondering how things got so expensive. This channel exists for people like us. People who work, people who try to do the right things, people who pay their bills, most of the time, and still feel like money keeps slipping through their fingers. Today, we're talking about something almost nobody calls what it really is. I call it the credit score tax. It's not a tax you vote on, it's not a tax that shows up on your paycheck, and it's not collected by the government. It's a quiet, invisible fee you pay when your life isn't perfectly stable, when your car breaks down at the wrong time, when a medical bill hits before payday, when you miss one payment, when your credit card balance creeps a little too high. Suddenly, the same house costs more, the same car costs more, the same loan costs more. Not because you're irresponsible, but because the system has decided you're less predictable. And predictability is what it really cares about. A credit score isn't a measure of how smart you are. It's not a measure of how hard you work. And it's definitely not a measure of your value as a human being. It's a pricing model. It answers one question only. How risky is it to lend money to you? And if the answer isn't perfect, the system doesn't say no. It says yes, at a higher price. In this video, I want to walk through exactly how that price gets calculated. We're going to talk about what a credit score actually measures and what it ignores. How just a small drop can snowball into massive lifetime costs. Why people with the least margin for error get punished the most. And how to lower or avoid this hidden tax without becoming obsessed with perfection. This isn't financial advice, it's education. Because once you understand how the system works, you stop blaming yourself and you start playing the game differently. Here's the part that surprised me the most when I finally dug into credit scores. A credit score doesn't measure how good you are with money. It measures how stable you are. That's it. Think of it less like a report card and more like a medical chart. It's not asking, is this person smart or is this person responsible? It's asking, does this person behave the same way every month? The biggest factor in your credit score is something called payment history. Did you pay on time? Every time? Without interruption? Not most of the time. Not eventually. On time. Every time. The system doesn't care why you were late. It doesn't care if your paycheck was delayed. It doesn't care if your kid got sick. It doesn't care if your car broke down the same week rent was due. Late is late. The second biggest factor is credit utilization. That's just a fancy way of saying how much of your available credit are you using right now. Here's the trap. When life gets tight, people naturally lean on credit cards. Groceries, gas, a few bills. Nothing reckless, nothing luxurious. But as your balance creeps up, your utilization ratio rises. And the system reads that as this person might be struggling, so your score drops. Not because you did something wrong, but because you needed help temporarily. Then there's length of credit history, which basically means how long have you been playing this game? If you're young, you lose points. If you took time off credit, you lose points. If you tried to live simply and avoid debt early in life, you guessed it, lose points. Notice something important here. None of this measures your income, your savings, your job stability, your effort, your intentions. A nurse who misses one payment during a crisis can look riskier than someone who carries debt forever but never misses a due date, because predictability beats wisdom. So when people say, you should have just been more responsible, what they're really saying is you should have never had a bad month. And for most working people, that's just not how life works. Let's put some real numbers on this, because once you see the math, it's impossible to unsee it. Imagine two people buying the same home, same neighborhood, same square footage, same price, $350,000. They both put down the same amount. They both choose a 30-year fixed mortgage. The only difference? One has a strong credit score. The other is about 50 points lower. That difference might change the interest rate by, let's say, 1.5 percentage points. That doesn't sound dramatic. 1.5 people hear that and think, that's not much. But here's what it does. At the higher rate, the monthly payment is several $100s more. Not once, not occasionally, every single month. For 360 months. Over the life of the loan, that tiny percentage difference turns into tens of thousands of dollars in extra interest, sometimes well into six figures. And here's the part that hurts the most. That extra money doesn't buy you anything. It doesn't get you a bigger house, a better school district, a nicer kitchen. You don't live better, you just pay more. It's like buying the same cup of coffee every morning, but being charged extra because the barista thinks you look a little risky. Now zoom out. That extra monthly payment means less room in your budget, slower savings, more reliance on credit cards, less flexibility when life throws the next curveball, which increases the odds that your score drops again. This is how the credit score tax compounds, not through reckless spending, but through pressure. And this isn't just about houses. Auto loans work the same way. A lower score can mean higher APR, longer loan terms, more interest paid on a depreciating asset, so the same car ends up costing dramatically more. And again, you don't get a nicer car, you just get a heavier bill. This is why I call it a tax, because it's unavoidable once you're inside it. You don't opt in, you don't negotiate it, it's just quietly applied, based on a snapshot of your life at its most inconvenient moment. This is the part that almost never gets talked about because on paper, credit scores look rational, clean, mathematical, fair, but in real life, they collide head-on with human psychology. When money is tight, your brain changes how it makes decisions. Psychologists call this decision fatigue. When you're under financial stress, every choice costs more mental energy. Which bill do I pay first? Can this wait until Friday? Do I use the card or overdraft my checking account? So people do what humans naturally do under pressure. They optimize for right now. They make the minimum payment. They postpone the uncomfortable choice. They buy time. And from a survival standpoint, that makes sense. But the system reads those choices very differently. High utilization looks risky. Minimum payments looks strained. One late payment looks unstable, so your score drops, which raises your interest rates, which raises your monthly payments, which makes next month even tighter. And suddenly you're not just stressed, you're stuck in a loop. This is what makes the credit score tax so brutal. It doesn't punish extravagance, it punishes vulnerability. There's a concept called the Sam Vimes Boots theory. The idea is simple. Poor people end up paying more over time because they can't afford the option that saves money long term. Credit scores work the same way. When you don't have margin, the system charges you for it. And the people with the least margin, they pay the most. This is why telling people to just be more responsible misses the point. Responsibility doesn't remove stress, and stress changes behavior. A system that ignores that isn't neutral, it's profitable. Because every extra percentage point of interest, every late fee, every penalty rate, that's money flowing in one direction. Not because someone failed, but because they had a bad month. And for a lot of working people, bad months aren't rare. They're normal. If this system punished everyone equally, it would still be painful, but it doesn't. It concentrates its damage. The people who feel the credit score tax the most are the people with the least margin for error. Young workers, families just starting out, people without savings, people whose income is steady but tight. When you're living close to the edge, a single expense can knock everything out of alignment. A medical bill, a car repair, a few days of unpaid time off. Nothing extravagant, nothing irresponsible, but enough to push a balance higher, enough to delay a payment, enough to leave a mark. And here's the cruel part. If you have money, credit mistakes are easier to erase. You can pay down balances immediately. You can refinance quickly. You can absorb higher rates temporarily without changing your life. If you don't have money, the same mistake lingers. It follows you from apartment to apartment, from job to job, from one phase of life to the next. This is why the credit score tax behaves like a poverty premium. It's not that poorer people make worse decisions, it's that the cost of being imperfect is higher. There's also a timing problem no one talks about. The moment in life when you need credit the most, buying a home, starting a family, replacing a car so you can keep working, is often the moment when your finances are the most fragile, which means the system evaluates you at your most vulnerable. That's not an accident, that's how pricing models work. Risk isn't eliminated, it's charged for, and the charge shows up as interest. So when two households earn the same income, but one pays hundreds more per month just to borrow, over time their lives diverge. One builds savings, the other treads water, not because one was smarter, but because one was cheaper to lend to. This is why credit scores quietly widen gaps, not in dramatic ways, but in slow, grinding ways, month after month, year after year. And unless you understand what's happening, it just feels like you're falling behind for no reason at all. Here's the good news. You don't need a perfect credit score to escape the credit score tax. You don't need to game the system. You don't need to obsess over every point. What you need is stability. Because remember, that's what the system is pricing. So instead of chasing a number, the goal is to reduce the moments where your life becomes expensive. 1. Stability comes before optimization. Most financial advice starts with optimization. Maximize returns, minimize interest, hack the system. That's backwards. For most working people, the biggest enemy isn't inefficiency, it's fragility. A single missed paycheck, a single emergency, a single bad week. So the first goal isn't investing, it's cushioning. Even a small emergency buffer, 100, 300, 500, can do something powerful. It can prevent late fees, overdraft charges, penalty interest rates, credit score hits that last for years. That money doesn't grow, it doesn't compound, but it protects. And protection is underrated. 2. Credit cards aren't the enemy. Timing is. Credit cards get blamed for everything, but the real issue isn't credit cards. It's utilization at the wrong moment. Here's a simple shift that helps more than most people realize. Instead of waiting for the statement due date, pay cards multiple times per month. Why? Because credit scores don't care how responsibly you paid. They care what your balance looked like when it was reported. Lower reported balance, lower utilization, higher score. Same spending, different timing. This isn't cheating, it's understanding the rules. 3. Don't apply for credit when you're vulnerable. One of the most expensive mistakes people make is applying for major credit at the worst possible time. Right after a job change, a medical expense, a high utilization month, a period of instability. That's when your score is least forgiving. If you can delay big applications until things settle, you often buy yourself lower rates, better terms, less lifetime interest. Timing doesn't fix everything, but bad timing makes everything worse. 4. The goal is forgiveness, not perfection. Here's something that doesn't get said enough. Your credit score is not your character. It's not your intelligence. It's not your discipline. And it's not a moral judgment. It's a statistical guess based on limited data. So if your score took a hit, that doesn't mean you failed. It means life happened. The real win isn't having a flawless record. It's building a life that can absorb mistakes without becoming more expensive. Because mistakes are inevitable. The system knows that. It just charges you when they happen. If you take one thing away from this video, let it be this. Most people aren't struggling because they're careless with money. They're struggling because the system charges them extra for being human. A credit score doesn't ask whether you tried your best. It doesn't ask whether you were sick, stressed, or stretched thin. It just asks whether you were predictable. And when you weren't, it sent you a bill. That's the credit score tax. It shows up quietly, in higher interest, in tighter budgets, in years of extra payments you never planned for. And the worst part? Most people blame themselves. They think, I should have known better. I should have been more disciplined. I should have handled that month differently. But understanding this system changes that story. It shifts the focus from guilt to awareness, from shame to strategy. You don't beat this system by being perfect. You beat it by building stability, by giving yourself a little room to breathe, by protecting your future from one bad month today. Because wealth isn't just about numbers on a screen. It's about time. It's about flexibility. It's about not having your life quietly taxed when things go wrong. If this video helped you understand something you felt but couldn't explain, consider sharing it with someone who's paying more than they should and doesn't know why. Subscribe if you want more conversations like this. I don't want you to be wealthy on paper. I want you to be wealthy in life.